Bonjour. Good morning, everyone. Welcome. I hope those of you who enjoyed the party last night are feeling suitably refreshed this morning. I'm delighted to introduce Graeme Pitkethley, who's the CFO of Unilever. The bad news this morning, for those of you who are a little tender, is you will have two Scotsmen on the stage talking to one another. Please do tune in as best you can. We'll have about half an hour of questions from myself, and then we'll open it up to questions from the audience. You can put those forward either by putting your hand up or via the Exane Cube, and I'll receive them here on the iPad. So with that, perhaps let us begin, Graeme.
Yep.
So you recently announced that from July you're moving to a new organisation structure around 5 category-focused business groups. Why? Why do this now? What benefits is this going to bring to Unilever?
Well, morning, everybody. Jeff, the first thing to say for everybody is this is a very significant change in the organisation and the operating model of Unilever. We don't do it lightly. For decades now, we've been organised around our current framework, which is 3 global divisions and 15 performance management units, which are largely focused around geographies. And a lot has changed. A lot has changed in the consumer landscape. A lot has changed in the competitive landscape. A lot has changed in the channel landscape of our brands and the interaction with consumers. One of the questions that we asked ourselves, and we actually made the decision to change the organisation back in 2019 and couldn't implement it because of the pandemic. But the question we were asking ourselves is, with the great brands we've got and the great people we've got, why does the same level of input effort not deliver the same level of output result? So we did a lot of analysis around it, and yeah, we came to the decision that we should change our organisation to become more category-focused, simpler, and most importantly, and this is probably the best way to understand the focal point of the change, we will no longer make decisions at the level of a geography in maximising P&L result, which cut across categories. So we're going to organise ourselves with a much leaner corporate centre. We're going to have a foundational layer, which is called Unilever Business Operations, which is basically a combination of our supply chain and our technology backbone and our global business services. And then we'll have 5 global business groups, which are end-to-end accountable for both long-term and short-term strategy, and they will make those P&L trade-offs within a more focused category organisation. The five business groups are beauty and well-being, personal care, home care, nutrition and ice cream. You've got 4 businesses which are above 10 billion euros, so scale, really big scale businesses, and one which is just under 7 billion euros, which is the ice cream business, Jeff.
Okay, thank you. Now, if I reflect over the few years I've looked at staples companies, companies who've made this change from a sort of geographical axis to a category one, it's never been smooth. It's always been quite difficult, that transition. Yeah. So, what are you doing to make sure that maybe a wheel doesn't wobble at Unilever as you kind of move through this? I mean,
you're absolutely right. This collapse of the matrix is something that is, as I said, it's a very significant change, and all change comes with risk. You have to be sure that the level of risk you're taking on and the cost of the change is justified by the end destination. We're absolutely convinced that it does. We're stepping up the performance in Unilever. We've done various changes around restoring our competitiveness, focusing on a very simple 5-point strategy. We've made substantial changes to our portfolio, largely through divestments of spreads and tea and building prestige beauty and functional nutrition, which have stepped up the growth rate of the company. And the final point, which underpins that step up in performance, is the change to the organisation and the operating model. Now, what are we doing in order to secure that underpinning? We've got a transformation office in place. The most important thing, because we're making a very quick change, we've moved at great speed to put this change in place. We will successfully implement it at the end of this month. The new organisation will be the way we operate the company from the 1st of July onwards. Leading the transformation office, we've had two very strong leaders in Unilever, Nitin Paranjpe and Rohit Jawa. Some of you may have met Rohit before. He previously has been managing our business in China and North Asia, so two very strong leaders managing that. And in terms of just managing the transition itself, the whole organisation is focused on delivering the first half performance under the existing organisation. We've incentivized everybody to deliver on the first half, and then the model flips across. So we've put a great deal of thought into it, a great deal of investment and resource behind it, good leadership behind it, but you're right, it's not without some risks.
Okay, thanks, Graeme. You mentioned your strategic thrusts, and one of those is to move into higher growth spaces. But there's been, I'd say, criticism in certain quarters, perhaps here, that you've done a lot of small M&A moves, but you've perhaps not leveraged those, across the organisation as much as you could have. How would you respond to that criticism?
Yeah, I think some of the criticism is fair if you go back from the period from, say, 2015 to 2017, 2018. We did a large number of acquisitions, some of them quite small. However, I don't think I have done a particularly good job of communicating exactly what we've been doing from a capital allocation perspective. Because from 2017 onwards, and absolutely from 2019, we have been extremely focused in the acquisitions we've made on exactly the strategic priority categories that we've called out. And so let me just give you the data so that everybody can absorb the facts. Since 17, we've invested 16 billion euros in acquisitions. 90% of that capital has gone on the three priority areas that we called out for shifting the portfolio. Prestige beauty, functional nutrition, where we've built a business of 1 billion and 1.5 billion respectively, and we'll continue to build those businesses, and BPC. So 90% of that 16 billion of acquisition capital has gone there. And that has delivered 70 basis points of growth accretion last year, 80 basis points of growth accretion in the first half. The divestments we've made have also been similarly focused. Since 17, we've divested and realized 11 billion through disposals, and that has been our spreads and our tea business. And if we'd not done that, then our growth would be 40 basis points lower. So that adds up to rotating about 17% of our portfolio. And when you benchmark that compared to our peers and the best companies that we compare ourselves against, that is highly correlated. It's very much a similar level of transformation. So it's been very focused. It's achieved exactly what we set out to achieve with it, and the benefits are now sitting in the underlying growth potential of the company. As I said, I feel that we've not taken that message out strongly enough. I think it is fair to say that we did a number of small transactions. The sweet spot for us is really a business with a turnover of about 200 million, perhaps 100 million. And in fact, the acquisition that we announced a couple of weeks ago of Nutrafol into our beauty and wellbeing business group is a very exciting hair wellness brand, #1 dermatologist recommended brand in the US. That sits in exactly that sweet spot. And some have been slightly larger than that. Things like the Horlicks business in India was about 500, 600 million of turnover when we acquired it. So that's where you can expect us to be focused.
Okay. Thank you, Graeme. Another of the 5 strategic thrusts is to accelerate growth in the US, India, and China. With respect to the latter, clearly Russia's invasion of Ukraine's kind of changed the macro picture. Has it changed your view on China from a sort of longer-term perspective?
Not at all. No, it hasn't. As part of our 5-point strategy, we also call out building further scale in 3 priority markets. Those 3 markets are the US, India, and China. So first thing to say is China remains very much one of our 3 priority markets. By the way, those 3 geographies are about 35% of the turnover of Unilever. I think sometimes Unilever, we've got a big, broad portfolio. It will be simpler to communicate and understand through the new organization, and I look forward to to starting to discuss the company through that lens. But we're not really that complicated. You know, the 13 brands that we have that are above €1 billion, and that includes brands like Dove at 5 billion, Knorr at over 4 billion. Those 13 billion euro brands are more than 50% of the turnover of the company. So more than half of the company is there. And as I said, more than a third of the company is in those three priority geographies of the US, India, and China. Turning to China specifically, we've got a fabulous business in China, first of all. We have world-class R&D capability there. We have deep distribution in the marketplace. We have a very, very competitive business. And we have a fantastic talent base. We're a very strong employer brand in China. And the business is 99% staffed by Chinese nationals. It's the third largest business in Unilever. It's just over 3 billion euros. And as I said, performing very nicely. The new organization will be another pivotal moment in our Chinese business because for the first time it will be led by a Chinese national in the form of Frank Q. So look forward to that and look forward to the success of China continuing.
Okay. Thanks, Graeme. It'd be remiss of me not to ask some questions about inflation. So we're going to have an inflation spell. Yeah. Now you recently commented that you had an expectation that you could restore margins over the course of 23 and 24, but that was partly based on an assumption that there'd be some normalization in cost inflation. So does that mean that commodity prices need to reduce somewhat for you to restore margins, or how are you thinking about it?
A little bit, Jeff. I mean, let me make one point forcefully at the start. We are not setting a margin target for the company. We've had one in the past, and to be honest, it has followed us around over the last couple of years as something of a black cloud. The business is entirely focused on accelerating the top-line growth of the company and doing that in a much more consistent and metronomic manner. And as I've said, we've done the work on competitiveness. We're now winning share in 58% of our business. That was leg number one, fix the fundamentals through operating focus. That job was done. That was the focus from 2019. The second critical focus has been execute that simple 5-point strategy, which most of you, I think, are familiar with, and we've been very, very consistently executing through those five strategic priorities. And the third thing is underpin that with the organizational change in the company. They're the three things that you should think about in terms of what we've been doing with the company. When it comes to inflation, I hesitate to use hyperbole really, but it is truly unprecedented. Just to scale it for everybody, we expect, and I think we communicated this with our Q1 results, that net material inflation, which is what we will see in our P&L on a 20 billion cost base annually, will be around about 4.8 billion euros. That's what we told you at Q1. The similar level of inflation last year was 1.3 billion, so let's call it 6 billion over a 2-year period. Just to put that in context for you, over the last 10 years, the levels of net material inflation that we would typically see in the company are between 200 and 300 million euros. So it's 6 billion over 2 years versus 200 to 300 million over the last 10 years on average. So even though I don't like hyperbole, I think that it's definitely unprecedented. So our strategy with that is to be priced to the maximum. We believe that's the right thing to do because unmitigated, the inflation levels that we have would be a 900 basis point erosion of gross margin. And we have to price, and we have the strong brands, and we have the pricing power, and we have, with 60% of our business in emerging markets, we can lead on pricing. And the reason we're doing that is to retain the ability to invest long-term behind the health of our brands. Now, we have to be careful and responsible in how we do that. We cannot price beyond the ability of consumers to avoid it. Pricing is a feature of relative price in the market, the competitive dynamic, the relationship with retailers, and the strength of your brands. They are the things that you're managing in that elasticity equation. And what we did when we looked at, to your question about potential time it takes for the recovery and restabilization to take place, the first thing we did is we went back and looked at history. And the previous two spikes in inflation we've had where when we identified those, I think it was 2008 and 2011, 2012. 2008 we had about 1.8 billion of inflation. 2011-12 we had about 2.4. Again, put that 4.8 in context against those numbers. But when we look historically, our gross margin typically recovers over a 1 or 2 year period thereafter. So the first thing we did was look back at history. Then we looked at our main commodity components, things like crude oil, palm oil, and soy, and we looked historically, where are the absolute levels of prices today in the market relative to how they've cycled on a multi-year time series. And you can see that we're at multi-year highs here, so all of which would lead you to believe, more likely than not, there will be some stabilization in those prices over time. And then you ask yourself, what combination of pricing, price carry forward, cost saving, and some normalization of commodities, what does that say in terms of that historical pattern of recovery over about a 2 year period? And when you model it out in simple scenarios, and it is obviously very volatile and uncertain, but what we wanted to do was share the fact that typically over a 2 year period you see a recovery. It does require some form of moderation from the multi-year highs that we're at today, but we believe in supply-demand dynamics. We believe in the ability of things to normalize over time. We don't believe that we're going to ratchet, this is a ratchet point, and things will just carry on inflating at a moderate rate from these all-time highs. Things should normalize. But yes, some slight moderation is required. Our model is highly levered. It doesn't take much in terms of carry-forward pricing and some moderation of commodity highs to allow that margin to restore reasonably quickly. But as I said, we're not setting a target for that, but we wanted to share the sort of time period it could take and the circumstances under which things can recover.
Okay, thanks, Graeme. On a sort of related subject matter, you and many of your peers have recently commented that elasticities have been better than expected, or better than historical norms. Is that why do you think that's been the case? And looking forward, is this kind of a kind of false period? Are you concerned as we look forward?
Actually, I'm finding this. I mean, everybody that works in consumer or in retail and grocery, etc. I think we all have a love of the space, right? You're in it because it's a dynamic, exciting sector to be in. And just intellectually, I find this period of inflation and pricing extremely interesting moment to live through, because what we're doing is we're really testing the strength of brand equities. We're testing the strength of brand power. We're testing whether a brand is meaningful, whether it's unique and differentiated, and whether it has high saliency. Now, the way that we measure that across our brand portfolio is what we call brand power. It's a Kantar measure, I think, originally. We know we've got really strong brand power. I know there's been a lot of discussion about is Unilever under-investing in its brands, under-investing in its business, but our brand power levels are really very strong. They're the highest positions that they've been at. 80% of the turnover of Unilever represented through our brands. Our brands are either holding stable brand power or increasing brand power. It's a very strong position to be in for us historically. And as I said, that's really important. When you're thinking about elasticity, there are really four things. The first one is brand power. The second one is the competitive dynamic in particular markets, and I'll share in a second a little bit how differentiated that is market by market. The third thing is consumer affordability, that point around responsible pricing that I mentioned. There are many, many pressures on consumers from different sectors, all sorts of food staples and energy prices, etc. And we have to be cognizant that share of consumer spend and wallet is an important thing. And the fourth thing is relative pricing. It's very important to think relative pricing when you're looking at elasticity modeling, because it is relative pricing. The other thing I find fascinating is that point around relative pricing. I mean, one of the challenges when you go back and look at historically, and our teams do a tremendous amount of modeling around elasticity, some of those models are being tested because the levels of inflation and pricing we're seeing are higher than anything we've seen in the past. But as a counterbalance to that, it is as if inflation is in every single consumer's mind in every corner of the planet right now. it's almost like the saliency of inflation is absolutely enormous. So you're not having to, oh, we've got a particular problem, we're going to have to raise the price of this brand. It's that is that's not something that we're pushing back against. So far, we've seen elasticities which are slightly lower than we had modelled out. Our businesses around the world, and this has to be managed locally, are managing pricing and volume elasticity brand by brand, channel by channel, market by market, SKU by SKU, and so far they're doing it really well. But it's a job where you have a triangle to manage, and this is the way that we've been viewing it within our business. The 3 points of the triangle are price and margin at one corner, competitiveness at another corner, and fundamental cost and savings in the other corner. And they're the 3 things that are being managed in balance in any one of our markets, Jeff.
Thanks, Graeme. Sort of labouring the subject of volumes, if we look at the remuneration structure, Unilever, volumes don't seem to feature anywhere. So, is another danger that, if you're getting targeted on organic sales growth or just value share, that there's a kind of incentive to maybe overprice and, we will have a sort of volume hangover down the line?
Yeah, having studied this for years, and if you had the perfect consumer products company, I've often thought you would only actually need 3 measures. In an ideal world, and this is a sort of utopian dream, you would have volume growth, gross margin, and competitiveness. They're the 3 things. In a perfectly balanced world, because volume growth is real growth, gross margin, is fundamentally, important, and is your business running competitively? They would be the things you'd get to. Unfortunately, that utopian sort of thing never really pulls through. The way in which we if we had, for example, volume targets in the business today, you can envisage a situation where people would not price at the level that they should price in order to protect the equity of the brand and protect the ability to continue to invest in the equity of the brand over the time. So there's no perfect solution. In our long term, just to share with everybody, we've got short-term targets and long-term targets. They're all in our annual report, and there's always debate around the choices you make. And you can't choose everything, obviously, because the objective of any remuneration plan is that the first thing it needs to be is understandable by the people that it applies to, and you can't be overly precise with it. But in our short-term targets, we've always had sales growth. And that's important, that's important. And so there's always a growth element to that. Longer term, we've got ROIC, we've got sustainability progress, we've got free cash flow generation, and we've got the competitiveness of our business. Now, one of the debates that we often have is, I get competitiveness, but why is it long-term competitiveness? And actually, long-term competitiveness, because our long-term comp targets are 4 years, the 4-year run and a 1 or 2 year hold, I think, beyond that. So they're very long-term. Achieving competitiveness of your business on a 4-year basis is much harder than achieving it on a 1-year basis. So there are arguments, I think, for bringing competitiveness into a more 1-year basis and perhaps moving sales growth or something like that into a longer-term basis. That's the sort of debate that we have quite a lot, around the compensation committee, etc. When it does come to volume, though, absolutely, we're measuring volume share, and all of that is a feature of the quality of result of performance, which is a big feature on our remuneration that we have with the performance units themselves. So it's not that we ignore it; it's there. It's just not called out in the headline metrics.
Thanks, Graeme. I guess earlier this year, a few things happened.
So,
it was a
January was a long year, as we've been saying.
Yeah. So I would just want to touch on a few things, if you don't mind. And I guess the first thing is that the sort of investor feedback on the proposed GSK consumer health transaction, seemed to be very divorced from where management and the board were. So how did Unilever sort of find itself in that situation where there was kind of such a divorce in views, and has anything changed to sort of make sure that that doesn't happen again in the future?
Well, let me just share a little bit of the background to it, so you have the context. I think we would all agree that the board of a company are tasked with thinking about the longer-term strategic future of the company through a longer lens, perhaps a 10-year lens, perhaps a 20-year lens. And what we did, management and the board, over about a 2-year period was conduct a very open-minded, objective and transparent review of what Unilever is and its overall portfolio positioning. And as a result of that work, we identified 3 adjacent categories that were attractive to us. The first one was prestige beauty, where we concluded that the strategy that we've been implementing over the last 4 or 5 years is the right strategy and is a winning strategy and is the right way to pursue prestige beauty and building scale in beauty as one of our strategic portfolio moves. The second area we identified as very attractive was pet food. And we very quickly concluded that that was highly consolidated and not accessible to us at scale. The third category we looked at was consumer health, where we concluded that it was the opposite of pet food. It was not consolidated and was accessible at scale. We then asked ourselves, well, what are the most attractive assets in consumer health? And we identified the GSK consumer health business as a very attractive asset, one of the best assets, if not the best asset in the space, in order to build scale. And of course, there was a moment in time opportunity which we acknowledged was not ideal from our perspective, given the performance of our valuation, given the confidence we had that we have stepped up the performance of the growth rate of Unilever to achieve higher growth more consistently. I mean, one of the things, Jeff, that happens is we've been seeing all of the output measures that trail higher performance of the company. We see that coming through in the results of the business. And as I said, we stepped up the competitiveness. We've changed the portfolio. Now we're changing the organization. So perhaps the board and management had a higher degree of confidence, which is not yet reflected in the value of the company around it. But we acknowledged that this was a fantastic asset, which was becoming available at a unique moment in time. But that timing was not ideal, and therefore it was extremely important that if we engaged in a discussion, it would have to be a private discussion, and that's where we were. And I think it's now been acknowledged. I mean, there's been, lots has been put out about other companies having interest in that particular asset. So I think if we feel at least that validates the fact that the board was not stepping outside its fiduciary responsibility to you in considering something like that. Now, what happened was the very worst outcome in terms of the range of outcomes that we had assessed when we talked about it, and that was that the news of our private discussions leaked, and leaked in a way that was extremely damaging for us. I mean, the extent of the leak, the timing of the leak, the extent of the disclosures, etc. And that was very damaging to the company, and we very much regret that. And we've been very clear that we will not consider transformational M&A for the foreseeable future, and we absolutely get that. But I do want to be clear, because a lot's been written about it, a lot's been said about it. We did not get the opportunity to take our thinking to you, and an awful lot of thinking had been done. This was not ill-considered. This was not, well, we've got problems with our current portfolio and we're unhappy with it. We need to make some, incredibly bold move. None of that was true. It's not the case that we are in any way dissatisfied with our nutrition and ice cream businesses. That's not the case either. It was simply considered through that lens of longer-term portfolio strategy and a moment in time that was an opportunity. And should we have a private conversation, we concluded we should have a private conversation. That leaked. And effectively what we have is a very well-crafted book, but we have only been able to discuss one chapter of that book with a limited number of you, and that in itself is very damaging. Now, it was a moment in time, it's history, we put it behind us, we will not consider transformation deals. We've heard our shareholders, and we've engaged enormously with our shareholders. But I did just want to, and I don't want to be defensive here, but I did just want to share with you the thoughtfulness, the objectivity, and the logic of what had happened in the boardroom over the last 2 years in considering this. This was not something that we shoot from the hip. It was not something that was ill thought through. We acknowledged at the time there was a unique moment of opportunity. The timing was unfortunate because of the performance of the company, in particular the performance of the value of the company. But all that considered, we still considered that making contact was in our interest.
Thank you, Graeme. Very helpful. If I can do one sneaky follow-up on GSK before we move on to other matters. One element that I found really interesting was the suggestion that potentially you'd have sought to IPO your food and refreshment business. Why wouldn't that make sense now? Why would that only make sense as part of the sort of GSK shift?
Well, our food and refreshment business is 40% of the company. And just to go back a second to the divestments, the 11 billion of divestments that I mentioned earlier, our food and refreshment business was capable of growing, prior to the divestments, about 1 to 1.5%. When you're trying to grow a company in the upper half of a 3 to 5% growth range, and the number I always have in my mind is the midpoint of the upper half of that, so call it 4.5%. I think Unilever is a machine for value creation and value unlock at 4.5% metronomic growth. Consistent 4.5% growth is fine. We don't have to do 6. We just have to step from 3 to 4.5 just to anchor. It's not a transformational leap. It's a leap that's eminently achievable, and we're getting there. When you're trying to hit 4.5% and 40% of your business will deliver 1.5%, that puts a tremendous mathematical burden on the other 60%. With the divestment of spreads and tea, we have exited almost 25% of that food and refreshment business, and it now has an inherent growth profile which is easily above 3%. And if you ask Hanneke, who's the president of our nutrition business now, she would say above 4%. And that fundamentally changes that ability for Unilever to move its growth up towards the top half of the 3 to 5% range and do it extremely consistently. And therefore, in no sense are we dissatisfied with our food and refreshment business. We've done tremendous work organically on improving the brands and the relevance, naturals, vegan offerings, clean label, etc., exciting flavors on brands like Knorr, Hellmann's, and of course Magnum. So we've got a tremendous foods business, which it's a fantastic part of the company. However, what we did was see an opportunity to move the company with more focus towards health, hygiene, and beauty. And in the context, and only in the context, of considering a move at scale into consumer health, we identified that the costs of separation of the food and refreshment business would be justified because incoming synergy opportunities would solve and create a viable value creation pathway. So just to drill into that for a second, we, of course, have done, because we are very objective and open-minded, we've done a tremendous amount of work on what the costs of separation, what the value consequences of separating food and refreshment would be. They are principally capital gains taxes. It's principally fiscal consequences in 100 countries around the world. And Unilever is not a conglomerate company. Every one of our businesses is a single operating company in a single country, by and large. And the brands are tightly integrated, and the brands are, generally speaking, brands that we've held for decades. So there's not really much of a tax base. So the fiscal consequences are pretty material. But we debated objectively whether bearing those costs on their own, simply to separate into two companies, is a value-creating outcome for shareholders. And the board came to the conclusion that they were not, unless there was a situation where you could have inbound synergies that would justify making that change. Having said that, the new organizational design, as I said, will underpin growth and will make our nutrition and ice cream businesses even better. And if they don't, we know exactly what the costs of separation are, and we would have to consider alternatives. We believe the right thing for now is we implement the new operating model, we run the business better, that underpins performance, and we are highly, highly excited about the prospects, not just for ice cream, but for nutrition, and we're really looking forward to being able to talk more about those businesses through the lens of the more focused business groups, because I think that improving people's understanding of the opportunities and the actual portfolio we have in nutrition and in ice cream would head off at the pass that question of, well, you know, you're not really in love with that business, should you separate it, etc.
Thank you, Graeme. And that completes the GSK part.
Thank
You'll
you.
be delighted to hear. Just remind the audience, if you would like to ask a question, please do so via the cube or put your hand up. And maybe before we move to questions from the audience, just one question on sustainability. And I was reflecting back, and you know, when Paul Polman came in back in 08, 09, you know, Paul made a big thing about sustainability, and that would drive, you know, basically a superior return for shareholders, which kind of didn't really happen. You know, when Alan Jope took over, he effectively said the same thing, and you know, to date, that's not really happened. So, you know, at what point does Unilever sort of say, well, you know, actually this is, you know, not really working, you know, this sustainability focus and delivering superior returns for shareholders as well?
Yeah, we still believe that there is no opposing force between an integrated sustainable business model and superior financial performance. In fact, we believe the opposite, and we still believe that. And you know, it's based on a lot of strategy, a lot of data, a lot of information. But I do want to be clear about the sequencing of the cart and the horse here. We're not trying to create a sustainable business model and then see what the financial outcomes of that are. It's much more explicit. We believe that by having a tightly integrated sustainable business strategy, we will create superior financial performance more consistently over time. It's a hard-edged business decision. The reason why we run our business this way is we believe it will result in outperformance. And we believe that for many reasons, but the most obvious one is that the majority of our consumers, we're a brands company, consumers are what we think most about. The majority of our consumer base, and this will only grow over time, are millennials and Gen Z consumers. And millennials and Gen Z consumers absolutely care about the business and brands that they're buying and consuming. They make that choice. There are other reasons behind it. We actually use the best way to think about it is a sort of four-point quadrant, if you like. The first one is growth, and I've sort of covered that, because if more and more of your consumers care about this, then they will prefer your brands over time. Your brands will remain strong. So growth is the first part of it. The second one is actually cost. We believe that by running our business this way, I mean, the cost that we have taken out of our supply chain in thinking responsibly about the nature we buy, the agriculture we buy, the water we use, the energy that consume in our factories, etc., that has resulted and will result over time in savings within our business. There's a cost argument behind this. The third one is risk. You know, by getting ahead and making your business more sustainable, you head off and de-risk the things that will happen over time as externalities start to be valued and taxed. You run ahead and you reduce the risk of the company. And the final one is trust. It's the trust of everybody associated with your business and the trust of your consumers fundamentally. So it's about growth, cost, risk, and trust. That's why we think about it that way. We're absolutely, I mean, I've been bristling about this actually over the last 3 or 4 days, but Unilever is not a woke company. Absolutely not. This is an explicit business strategy. Although I acknowledge that, I mean, given our valuation performance, which is extremely disappointing for us, and we think about it a great deal. I mean, just to share that, Jeff. I mean, you know, I think when I came into this role, we measure ourselves against TSR, 3-year TSR against a group of 19 companies. I think we were in number 16 position when I came into this job. We got to number 3 by the middle of 2019, and now we're back in number 16 position. But we know that the way to resolve that is to grow faster, more consistently, no surprises, and deliver metronomic performance in the upper half of our growth range. And we believe if we do that, we'll unlock the value in the company. And there is value in Unilever.
Thank you, Graeme. We're now out of time. However, there is an interesting question from the audience, so if we can do it in 20 seconds.
Of course.
Nelson Peltz, has he shared his views with you? And what do you expect his views are if he hasn't?
Yeah. Let me just share quickly a little bit around. Obviously, the news came out that we're going to invite Nelson Peltz to join our board in a few weeks' time. Just to share with you that the board engaged over a few months in a very extensive process of engagement with Trian and Mr. Peltz in particular. And that was very satisfactory in terms of his candidacy to be a board member of Unilever. This is somebody who has, first of all, a very demonstrable track record of value creation in the consumer sector and deep knowledge and experience in consumer from everything he's done at P&G, at Heinz and Mondelez and other companies. So there was a full process around interviewing. Many of the board met Mr. Peltz. The Norman Govco met Mr. Peltz. And the conclusion for that is he would be a valuable addition to Unilever's board. So that's the first thing I'd say. In terms of what's been shared, a lot of what was shared was around his candidacy. Track record, this is my track record, this is what I've done in other companies, this is how I like to operate. Obviously, we did quite a lot of diligence in talking to other boards, other managers in the space around what their experience has been, and all of that resulted in a situation where we felt that Mr. Peltz would be a valuable addition to the board.
Graeme, thank you very much.
Thanks, Jeff. Thank you.
Please do come back next year when...
first time here. It looks good. Yeah.
Brilliant. Thanks
a lot. Thank you.